Okay, good morning everyone here in the US and good afternoon everyone over in Europe as well. My name is Ákos Lócz and I'm a Senior Research Associate at the Center on Global Energy Policy at Columbia University. And it is my great pleasure to welcome you all to this webinar where we will be discussing the IEA's new Medium-Term Gas Market Report and the latest trends in the global gas market. Now, those of you who follow gas markets on a regular basis will know that we went through an extremely turbulent and volatile period in the last 3 years. In 2020, we had a spectacular market crash and a global gas price collapse after COVID-19. In 2021, we had a very strong recovery and sporadic gas crisis around the world. And in 2022, we had the biggest gas supply disruption we have ever seen in Europe, which had also ripple effects around the globe. So far this year, it seems like we have moved past the most acute phase of the crisis and prices have indeed returned to the normal historical range, although they have been rising again in the last few days. But the permanent loss of more than 100 BCM of Russian pipeline gas almost overnight has left us with some deep and structural changes in the global gas market that will stay with us for the foreseeable future. If this wasn't enough, the outlook for gas is further complicated by the energy transition and the interplay between natural gas, low-carbon gases, and other low-carbon energy sources that are competing with gas in the energy mix. All of this means that gas markets are less flexible, more volatile, and more difficult to forecast than ever. I think the IEA does a great job and an important public service every quarter by bringing insight and clarity to these very complex issues in their quarterly gas market reports. And we are very fortunate to have them join today to guide us through their latest medium-term gas market report, which has a forecast to 2026 and a short-term update on recent gas market developments in 2023 as well. We are especially fortunate to have not one, but two speakers join us from the IEA. Dennis Hesselink, who is the head of the IEA's Gas, Coal and Power Markets Division, and my good friend and former colleague, Gergely Molnár, who is the lead gas analyst in Dennis's Gas, Coal and Power Markets team. We're also very pleased to have two very distinguished experts join us for the discussion. Andrew Walker, who is Vice President for Strategy at Cheniere Marketing, and my colleague, Tatiana Mitrova, who is a research fellow here at the Center on Global Energy Policy at Columbia. Now, before I turn it over to Dennis and Gergely, let me quickly remind everyone that this is a public event, which is open to the press. We are webcasting the event live, and the full recording of the event will be available online in a couple of days. For those of you who are joining us via Zoom, you can submit questions for the panelists at any time by using the Q&A box on the bottom of your screen. I should also mention that our events are closed captioned. You can turn on the closed captioning by clicking on the Show Caption button at the bottom of your screen. Now we will have a roughly 20-minute long presentation from the IEA, which will be followed by a 20-minute moderated discussion and a 20-minute Q&A session at the end of the program. So now without further ado, let me turn it over to Dennis and Gergely to present their gas report. Dennis, Gergely, welcome again. The floor is yours.
Thank you very much, Ákos. I will kick off on our end, and then Gergely will take over with the remainder and the biggest part of our presentation. It's nice to be here at this virtual event. It's a good way for us to indeed share our findings, but also to discuss how we see gas markets and to take questions and input from the colleagues here and also from those who are participating in this webinar. We have a few slides to take you through the main findings of the report. Gergely will put them on screen in a moment. I will do the key findings, and then he will take over with a more detailed expose of both the forecast part and also the market analysis part, providing an update on what we've seen happening in global gas markets over the last period. Well, I think we're waiting for the slides. Yes, they're coming on screen now. This is the Medium-Term Gas Report. It's available on our website for free, so you're welcome to download it and take a look. If we can have the next slide, please. So what we see, and this, I would encourage you to read the first two bullets in conjunction, because this report was released earlier this week. We closed the content, let's say the final parts, a week ago, and normally a week between closing and publication is not so long. However, in this case, some of the messages already changed a little bit based on recent event, the closure of the Tamar gas field in Israel, and especially what looks like sabotage of the Baltic connector here in Europe. Those are things which we don't cover in the report, but of course they have an effect on market functioning and on prices. So what we see here is, that's a disclaimer, this is about what happened until, let's say, this last weekend. What we see in gas markets, the tensions moderated significantly since the beginning of the year, amidst strong reductions in Europe of the demand and in mature Asian markets, And despite actually a market which remains, and you referred to this, Akos, in your introduction, it remains fundamentally still a very tight market. So thanks to the demand side, we're in a much better situation now than we were 1 year ago. We see markets moving towards a gradual rebalancing on a global scale. However, we're not out of the woods yet. If there are events happening, like a cold winter or LNG supply disruptions or blowing up of pipelines, that could be renewed market tensions, and we could see this also reflected in price levels and in price volatility. If we look to the peak, the gas demand that we saw over the last period, we expect it overall to slow by about a third and also be more concentrated. So we see less growth, or actually even contraction, in the mature markets in Europe and in the US. We see the growth more concentrated in Asia, in the gas-rich market of Africa, and in the Middle East. We expect the global energy supply to expand by about 25% over the 22-26 period, and especially in the second part of this period, so around 25-26. And that means that once we get there, so once we get towards 25-26, we would expect an easing of market fundamentals and less security of supply concerns, also better price levels in that period. Then with respect to low emission gases, we expect them to double over the medium term, starting of course from a lower base. And although that's very encouraging, it's still quite a bit removed from the targets that are set for biomethane and for low emission hydrogen, and that we want to reach for climate reasons. That's a very quick overview of the key takeaways. I will stop here and hand over to my colleague, Gerge Molnar, who will take you through those findings in much more detail. Gerge, over to you.
Thank you, Dennis. Good morning. My name is Gerge Molnar. I'm a gas analyst at the International Energy Agency. And first of all, many thanks for Columbia for hosting this event. It is a great pleasure to discuss with you all our most recent medium-term gas market report. The presentation will be structured in the following way. First, we will go through recent gas market trends and also a few hints for the winter outlook. And then in the second part of the presentation, we would like to provide a closer look on the key findings of the medium-term outlook, including on low emission gases. On this slide, we are showing the wide volatility ride on which gas markets have been on for more than a year and a half now. I think that it is fair to say that market tensions have moderated down significantly from their 2022 highs due to timely policy action, effectively working market forces, as well as favorable weather conditions in the Northern Hemisphere. And we are looking back at the second and third quarter. We see that gas prices, both in Asia and Europe, have been trading actually below their 2021 levels, but they remain significantly above their historic average. And of course, it is important to note that this easing of the market fundamentals have been very much a demand side story. On this slide, we are showing the evolution of natural gas demand among the key importing regions: Europe, mature Asian markets, China, and emerging Asian markets. And what we see is that in Europe, natural gas consumption have fallen by about 9% or 33 BCM, and this has been driven by all the end user sectors. In the residential and commercial sectors, a mild Q1 played into that picture, but actually what we have seen is that the non-weather related factors were the key driving force behind lower residential and commercial demand. And when we are looking at the second and the third quarter of the year, it has been mainly a power sector story, which accounted for almost the entire demand reduction in the second and the third quarter. And this has been very much due to lower electricity consumption on one hand, and on the continued expansion of renewables, as well as improving nuclear availability. And the third factor here is industrial gas demand, which have been down in the first half of the year. When we are looking at the latest data for July and August, we start to see a recovery in industrial gas demand compared to the very low base of 2022. One other building block when we are looking at Europe is that the storage injection needs have been quite significantly reduced. And this is because we opened the gas summer season back in April with quite high open stocks because of the reduced gas demand over the 22-23 winter. Moving to the major Asian markets, we see that gas demand is down by about 6% due to lower electricity consumption, but also improving nuclear availability, especially in Japan. Now, China is, of course, a completely different story, because here we see a strong growth of about 7%, which is partly driven by more activity in the industrial and commercial sectors, and also higher gas burn in the power sector, partly due to the lower hydro availability during the first half of the year. And when we are looking at India and some of the other Asian markets, we also see that they are returning gradually to growth, which is driven by higher gas to power demand and also a recovery in industrial activity. But when we are looking all together to those major import markets, we see that overall demand is down by around 20 BCM, and upon that we have to add also the about 20 BCM a reduction in storage injections. So this reduction in natural gas demand has been a key driver of easing up fundamentals. But we should not forget that the supply side remains fundamentally tight. And on this chart, we are showing the key channels of global gas trade, which is Europe's pipeline imports, China's pipeline imports, and global LNG supply. And the key point here is the red dot, which shows that the continued steep reduction in Russian piped gas deliveries, which was about 38 BCM during the first 3 quarters of the year, was not offset by the increase in global LNG supply, which increased by about 11 BCM. So we are still in a quite tight market when we are looking at it from the supply perspective. And this tightness is also in a way reflected in the very high price volatility which the markets are experiencing. On this slide, we are showing the historical volatility as it has been evolving on the TTF months ahead contract, which is the most liquid contract in Europe. And actually it shows that price volatility in August has been the highest since Russia's invasion of Ukraine. And this has been partly fueled by the strike risk in Australia, partly by the extended outages in Norway. And of course, when we are looking at the first 2 weeks of October, we see that this price volatility continued and remained quite strong, again reflecting on the fragility of the European and global gas balance. On the bright side, European storages are quite full. At the moment, they are standing at 97% of working storage capacity and about 10 BCM above their 5-year average. And of course, this should give us a cautious optimism ahead of the coming heating season. But at the same time, we should not forget that full storage sites are no guarantee against winter volatility, because there is a number of exogenous risk factors which are weighing on the winter outlook. And here we plotted some of the key risk factors we see which could emerge, such as a very cold winter in Europe, a continued reduction of Russian pipe gas deliveries, and a lower availability of LNG supply, either because of reduced output at the LNG plants or because China is returning to the market with a greater appetite. And of course, all these factors have negative impact on the European gas balance. So this is just to say that we are not out of the woods yet, and we need to keep demand in check, because this is the best way to mitigate against those exogenous risk factors. And of course, the recent developments, such as the damage caused on the Baltic Connector pipeline, also shows the need for heightened vigilance on critical energy infrastructure. With that, I would like to move on to our medium-term outlook and to give a brief overview of some of the key takeaways. On this slide, we are showing that global gas consumption, global gas demand is expected to increase by about 6% between 2022 and 2026. This is an addition of about 260 BCM, which is, of course, needs to be put in perspective. And when we are comparing it with the period 2017-2021, this addition is 1/3 smaller. So the demand growth, the global gas demand growth is slowing down. And the key driver behind that is that we see that gas demand peaked in the major markets of the Asia Pacific, North America, and Europe already in 2021, when we are looking at on those markets in an aggregated manner. And in our forecast, gas demand in those regions is expected to decline by 1% per year. And as such, most of the demand growth is concentrated in the gas-rich markets of Africa, the Middle East, as well as the fast-growing markets of Asia, in particularly in China, which alone accounts for half of incremental gas demand over the medium term. And when we are looking at this picture from a sector perspective, we see that industry is really the leading force behind higher gas use in the medium term, alone accounting for 60% of incremental gas demand. Now, this is a quite different picture from the 2017-2021 period, when it has been really the power sector which was leading demand growth. When we are looking at our forecast, we see that gas-fired generation is pulled to different directions across different regions. When we are looking at the mature markets, we see that it is mainly the power sector where gas demand reduction is concentrated due to the accelerated deployment of renewables and improving nuclear availability in some of the markets. But of course, in other regions, such as the fast-growing Asian markets and the Middle East, we still see quite a growth for gas burn in the power sector. So the two are largely offsetting each other, and this is why we, in our forecast, gas to power demand grows at a mere 0.5% over the forecast period. So this slide, I think, is key to understand our medium-term outlook. It shows the evolution of supply, which is going into the trade channels of which global gas trade is composed. And I think it shows that it will take more than just 1 or 2 years to recover from the gas supply shock triggered by Russia in 2022. But overall, during this period, global energy supply is going to expand by about 25%. And most of that capacity and supply additions will be concentrated towards the end of the forecast period, towards 25, 26. These 2 years account for about 70% of incremental LNG supply. And most of it will, of course, come from Qatar and the United States. The United States accounts alone for half of incremental LNG supply over the medium term. And of course, this strong LNG supply addition could ease market fundamentals and also unlock some price-sensitive demand in some of the key import markets in Asia. But of course, the picture is quite different when we are looking at the European market. On this slide, we are showing our forecast for European gas demand over the medium term. And as mentioned previously, most of the demand reduction is expected to be concentrated in the power sector. In Europe, we project a reduction of 25%, or about 50 BCM in gas burn in the power sector. And this is due to the accelerated deployment of renewables, improving nuclear availability in some of the markets, but also efficiency gains. And when we are looking at the residential and commercial sectors, a return to average temperatures would, of course, increase demand in those sectors. But we see that retrofits, efficiency gains, and the deployment of heat pumps is set to weigh on gas demand also in the buildings. And we see a moderate reduction in this demand segment as well. And then moving to industry, as we all know, European industrial gas demand was severely impacted by the gas crisis in 2022. Gas demand in industry dropped by about 20%. And in our forecast, we assume that about half of that lost demand is not going to recover during the medium term, partly because of the quite high gas prices, which again, historically, when we are looking at a history comparison, they remain quite elevated. And there is also a significant risk of relocation of European industrial actors to other markets, which have structurally lower gas prices and gas costs. Now, on this slide, we are just showing a bit the outlook for Europe's gas and LNG imports. The graph here shows the composition of Europe's primary gas supply, which is of course composed from domestic production in Norway, which is expected to remain relatively stable, EU plus UK production, in which we see different trends for the rest of Europe, because we see that in Northwest European countries, production continues to decline, but we see some upside in the Eastern European markets, including in Romania and in Turkey. For Russian pipe gas, we don't see any recovery. Actually, our forecast assumes that the transit flows via Ukraine are not going to continue beyond the current transit contract, which expires at the end of 2024. And of course, this picture leaves us with LNG imports, which are expected to remain close to their 2022 levels, but they are not expected to increase. They expected to average just a little bit below the 2022 levels, actually. So we don't see this very strong growth in the prospects of Europe's LNG imports. Now the picture is completely different when we are looking at China, where we expect that LNG imports will double from their 2022 levels, and China is expected to account for 2/3 of incremental LNG imports over the medium term. Now, this very strong growth is also underpinned by China's large portfolio of long-term contracts, which are expected to cover most of that growth. And here I just would like to remind ourselves that China has been pursuing an aggressive contracting strategy and accounted for about 30% of all the LNG contracts concluded in the last 5 years. And in our forecast, the country will be sort of pulling in those volumes under its long-term portfolio. Last but not least, in our low-emission gases work program, we are closely monitoring the development around low-emission gases, which for us includes biomethane, low-emission hydrogen, and e-methane. In this forecast, we see that low-emission gases will double over the forecast period, adding about 8 BCM of gas equivalent to the global mix. And this growth will be driven by biomethane and low emission hydrogen. Biomethane accounts for about 55% of incremental low emission gases supply. And from a regional perspective, it will be North America and Europe, which accounts for about 70% of incremental low emission gases supply. But we also see some bright spots emerging in Brazil, China, and India. When it comes to biomethane, our latest estimates indicate that it increased by about 17% in 2022, with growth almost entirely concentrated in North America and Europe. Over the medium term, biomethane production is expected to grow by around 65%. And when we are looking at the additions, again, it will be largely driven by Europe, North America, but we also see an expansion of biomethane output in other markets, such as Brazil, where we forecast a quadrupling of biomethane output, and India, where we expect that biomethane will rise by 10 times over the next 4 years, although from a very low basis. And when we are looking at the low emission hydrogen picture, we see a very strong pipeline of projects which could add about 12 million tons of low emission hydrogen output by 2026. But what we need to see here is that less than 20% of these projects are in a mature phase of development, which are either under construction or have taken FID or are already operational. So then we are focusing only on those projects. We see that only about 2 million tons per year, or 6 BCM equivalent of low emission hydrogen, will be deployed by 2026, most of it actually in North America and China. And of course, when we are comparing this with the ambitious targets set by governments for 2030, it seems that we are still a long way to reach those targets, and there is a need to accelerate, to double down efforts on the low emission gases to actually reach those targets across all the regions, but especially in Europe. I would like now to thank you for your kind attention and looking forward to our discussion. Thank you.
Thank you very much, Gergely and Denis. Excellent presentation as always. We will now move into a moderated panel discussion. Again, for those of you who are watching online, my name is Ákos Lósz, and I'm here with Denis Hesseling and Gergely Molnár from the IEA, Tatiana Mitrova from the Center on Global Energy Policy, and Andrew Walker from Cheniere Marketing. And we are discussing the IEA's latest medium-term gas market report. We will open up the floor for questions from the audience after this panel discussion. For those of you joining us via Zoom, you can submit questions for the panelists at any time by clicking on the Q&A button at the bottom of the screen. I see already 1 or 2 questions there. Before we actually get to my question during the panel, I would first like to ask Tatiana and Andrew to see whether they would like to reflect briefly on anything that was said in the IEA presentation. So, Tatiana, why don't we start with you?
Yeah, thank you, Ákos, and my applause to Denis and Gergely and to the whole IEA team. Really great job as usual, and really very important light in all this mess. I would first of all agree with the disclaimer that Denis made in the very introduction, that the things are changing so fast that even during just 1 week, we've got completely new factors defining how the gas market is looking. And the problem is, and I'm afraid that it's a fundamental problem, that now we should be focused not only on the supply-demand balance, not only on the market fundamentals, but much more on geopolitics. And I'm afraid that it's not like the last black swan which is visiting us. Unfortunately, the peaceful time is over. We have to admit it. There is this increasing confrontation, and therefore these sort of infrastructure threats and other destabilization and shutting down fields. I'm afraid we should keep it in mind as our new reality. And there is another impact that this global geopolitical instability is creating, impact on the way how gas is traded. So obviously it results in higher price volatility. We are observing it, but also this market fragmentation, when actually it's not like anyone can sell gas to anyone. There are new groups, new alliances evolving, and trading is changing. Non-dollar payments are rising, and new traders are evolving. It's not as strong as on the oil market, but still it is becoming visible. So the nature of this global gas trade is really changing. But at the same time, there are also some good news. I've started with the bad, now the good news. And I think it's really inspiring to understand how resilient the gas markets proved to be in all these disasters. I mean, if we could imagine 5 years ago, suddenly 100 BCM of Russian gas disappearing from the global market, it seemed to be a complete catastrophe, something that the markets cannot absorb and adjust to, but they can. And we know now for sure that they can do it. Which is really giving some hope. But at the same time, I'm afraid the whole job of IEA gas team will become much more difficult these days, trying to react to this very quickly changing geopolitical environment. But once again, thank you very much. Great job.
Thank you, Tatiana. Some very sobering thoughts there. Now let me turn to Andrew to get his reaction to the presentation. Andrew, over to you.
Okay. Thanks, Akos. Thanks for inviting me to come back and comment on the presentation again. Great job in terms of the data analysis, the content. Gergely, Dennis, fantastic. Hopefully you can make it shorter next time. I tried to read it all this morning, and there was a lot of information in there to read. Very little I disagree with in terms of the data, the analysis. Some bits I would kind of comment on in terms of semantics. When we look at the current market and you talk about steep demand reductions, I know you're kind of taking demand as consumption, but actually we're in a period where supply is curtailed, and really we're in a market where supply constraints are setting the consumption numbers. Prices are high because with constrained supply, the available supply is being reallocated on a price basis to whoever can afford to bid for it. So I think we need to be slightly careful about taking too many conclusions about the structural evolution of the market under those kind of near-term conditions. I agree with you that in the midterm, we're seeing a slowdown in kind of average growth over that 22 to 26 period. But again, that's an average, 1.6, but it's a very dynamic period. So you're taking an average of low growth at the front end and high growth at the back end. It would be equally accurate of me to say that after the period of supply constraint, we're going to see supply respond, rebound, and actually 2026, based on your figures, will be a return to above average supply growth. If we look at the last 2 decades, you've got 100 BCM of growth in there. The long run average over the last 5 decades has been 60 BCM, the average over the last 2 decades, 80. So we're going to enter a period where supply is responding as markets do. My other comment is the suggestion that the structural evolution in the market, the renewables, the heat pumps, etc., are kind of by implication pushing gas out. That's not kind of my interpretation. At the moment, we are supply constrained. And actually what was really happening in 22 was that renewables growth was actually balancing low hydro, low nuclear. And what we actually saw was that coal was filling the gap between the renewables growth and the energy demand and the gas constraint. So I think we need to be kind of slightly careful about wishing gas to peak too early, because we need adequate gas supplies. Otherwise, we're going to see people starting to lean on coal. 22 was a joint record coal year. I'd be surprised if 23 isn't kind of looking that way as well. So I agree with much of what was said. I'll leave you with one final comment. I will admit, I've come to these discussions each time saying you're too pessimistic, your numbers are too low. Actually, you get 500 million tons LNG trade before me. 25% growth from 400 is 500 by 26. I'm kind of a year later. But again, that is just the start of the S-curve. 27 is even more growth, 28 is even more growth after that. So actually, when we go out of the midterm period, we are seeing a huge supply response that will continue to grow the market. There we are, Akos. I've admitted I was wrong and that the IEA, for once, are more optimistic than me.
Okay, well, sounds great. So, yeah, let me rephrase one point that Andrew just made, and that was also my first question to you, Dennis and Gergely. So, your executive director, Dr. Fatih Birol, in September came out with a preview of the upcoming VO report, which predicted that all fossil fuels will peak in this decade, even in the current policy context. Which, for those of you who are familiar with the IEA lingo, that's the STEPS scenario, the stated policy scenario in the next VO report, which includes gas. So apparently, we are moving to the direction of peaking gas demand in this decade. So, as Andrew pointed out, what we are seeing, in fact, in your forecast is a slower average growth, but actually a reacceleration of growth towards the middle of the decade. So I'm curious if you actually see gas demand sort of moving towards this peaking or moving quite in the opposite direction.
It's a good question, Akos, and thank you for raising the point, Andrew. I understand that people are looking at this and saying, how does the overall picture fit together? If we see a peaking of all the fossil fuels, not just gas, but also oil and coal before the end of the decade, and then we look at the, let's say, more near-term forecast for gas, how do you square those two? And of course, there's a gap. I mean, we in this report, we covered a period until 2026. And Andrew, you're referring to 27, 28, what will happen there? We haven't looked in detail to that. What we look at are the underlying drivers. And you see a number of drivers that will, for sure, push gas demand down. I'm thinking about the increased availability and investment in renewable power generation. I'm thinking about electrification of heat, which is picking up. I would think that also, and I'm relating also to Tatjana's comments about the geopolitical uncertainty and the awareness people of the risks coming with gas these days, at least in some corners of the world. I'm pretty sure there will be political movements to push to reduce this risk. Let's put it that way. Now, these are some drivers which work out in some parts of the market. For instance, in Europe, in mature markets, in Asia, we see it happening. We see the opposite, and Gergely showed this in developing Asian markets in China. So there are different forces at play. I mean, we don't pretend to have a full and accurate forecast of the whole thing, but we do think that there are sufficient forces at work to also, let's say, enable a peak of gas before the end of the decade.
Yeah, assuming gas demand peaks, and this is a question to Andrew. We had the Gas Tech conference about a month ago in Singapore, which is the biggest gathering for the gas and LNG industry. And I wasn't there in person, but my main takeaway from the discussion was that the industry thinks that even if gas demand peaks, LNG will be fine and it will be growing for the foreseeable future, which seems to match well with what you have just said about we being at the beginning of the S-curve. So first of all, I want to ask you if you subscribe to that thesis that came out of Gas Tech, and you know what would be the factors that continue to drive LNG even if gas demand is about to peak?
Okay, thanks for the question, Akos. I was probably one of the people spreading that thesis at Gas Tech. But yeah, I do subscribe to the thesis that LNG is going to continue to grow even if gas peaks. Again, another semantic observation. Peak kind of implies like a mountain. we could equally say, what if gas consumption plateaus? Because I don't think we're talking about a rapid reduction in overall demand, something very different. So we can argue whether peak gas demand is 2029 or 2035, but actually it's more meaningful to talk about whether it's plateauing and how quickly it comes down. Now, within that, if we look at the gas industry, we know that gas markets develop as kind of an S shape. They start growing and then they pick up as you build out the infrastructure, you connect all your cities to gas, and then they start to slow as you get into organic growth, expanding those kind of regional markets, growing your industry. And we've seen that over kind of many decades. The US was a 600 BCM market by the early 70s, and then it was generally quite flat until the shale gas revolution when it took off again. Japan grew quite quickly in terms of developing LNG and probably peaked in 2014. I was looking at the numbers this morning. The European market as a whole probably peaked in the 2005-2010 period. I think where we're going to see a difference as we look forward is we're going to see we've never really seen markets decline properly. Japan kind of plateaued, Europe really kind of plateaued. So I agree with the thesis that we may start to see some markets come down, but equally we're going to see many markets continue to grow. Again, China, huge growth market. Your numbers, Gergely, I wouldn't disagree with in terms of the LNG growth. That's phenomenal growth. And I think LNG serves the last growth markets. It's going to serve China, it's going to serve India, Southeast Asia, South Asia. So actually, even if gas demand plateaus, I'm still pretty confident that LNG will continue to grow. It's about to grow by 50% by 2030. That's a huge increase. Having grown so much, it's probably going to slow growth by 2030 to 2040, having taken that big step up, but it's going to continue to grow. And then we can start to talk about the renewables, hydrogen, low carbon kind of balance as to whether there's another cycle after that and how much that moves it up by 2050. But I'm willing to bet my money that 2040 will be higher than 2030 in terms of LNG demand, and we will probably continue to see growth. But I would admit we'll see some markets going up while some markets come down. So the rate of overall growth will slow after that huge increment that we're about to see. Most of that is under construction. It's going to happen. There's about 200 million tons of capacity under construction. There's some decline in existing traditional fields. That means we need some more on top of that. But that wave is basically getting built in as we speak. Hopefully that answers your question, Akos.
It absolutely does. And it's interesting you and Gergely both emphasized the importance of China as probably the top driver of leading that growth going forward. I see Gergely has a response to that, so perhaps I should first. Please go ahead.
Yes, no, thank you for all those comments. Maybe just one point on how we see the end of our forecast period. So this year, towards 26 and potentially beyond. Yes, we see, an acceleration of demand growth by 2026, simply because, as we mentioned, the markets are going to rebalance from the 22 supply shock, and some price-sensitive demand will be unlocked mainly in the emerging Asian markets, as well as in China. Actually, most of that growth we see in the power sector, because in the Asian markets there is quite significant unutilized gas-fired generation capacity. So it will be able to absorb that wave of LNG. Now, I think that when we are looking beyond 2026, and of course this is we are not covering this in the report, but I think that here the most important factor will be the pace under which clean energy technologies are going to deployed in those last markets of gas demand growth. And I think that that's really the key determining factor. And if we see that, they will be deployed in an accelerated manner, that will, of course, at some point start to impact also on the supply side, and will have implications on how we use LNG liquefaction plants, potentially leading to greater seasonality, reduced operating rates in some cases, and potentially, a steeper declines when it comes to the oldest LNG plants. So I think that at some point there will be also a response coming to that new reality from the supply side. But again, this is not something we are covering in this report. Next year, the forecast horizon will extend until 2027. So hopefully we will have a similar discussion on that in 1 year time.
Yeah, thanks, Gergely. And I want to come back to the low carbon gas piece in a little bit of time, but I first want to note that looks like we are counting on China a great deal when it comes to driving future LNG demand. And of course, there is a 50 BCM question mark hanging over that in the form of the Power of Siberia 2 pipeline. And I wanted to ask Tatiana to perhaps comment on that. Perhaps there is some announcement on the horizon on Power of Siberia. What's the latest?
Could be. Yeah, because next week there is visit of Putin to Beijing and meeting with Xi Jinping planned. And on the Russian side, there are high expectations and lots of rumors that something could be achieved. We never know. But actually, for Russia, the bets are very high, and it's much more than just a gas deal. It's also a message about strategic partnership with China. And frankly, I assume that all the geopolitical background and, so this deal, if it happens, it actually marks like a new world. Yeah, it's not the reason of the new world, but it is just an indication. So let's follow what's happening. But actually, I wanted to add up to something that Gergely said, because Russia, which found itself with a huge gas bubble last year, it was looking how to utilize it. So domestic demand is growing. Actually, last year, 16 BCM. This year, I assume it will be something like this. So these are big numbers. It's a big domestic demand. It is looking for the outlet of its gas in Central Asia. And last week, they've just launched 3 BCM supplies. It's tiny, but plans are big as well. They're trying to push forward Power of Siberia 1 utilization, but after 1 year of rethinking Russian gas export strategy, now I think Russia is coming up with a new vision, which is basically focused on LNG. Yeah, Andrew. Just today, Novak has announced that Russia is approving Murmansk LNG. Yeah, so you wrote in your report, Denis and Gergely, that the first train of Arctic LNG 2 is coming on stream next year, and I'm pretty sure that it will be there. But there will be also this final investment decision on Murmansk LNG, another 20 million tons. And basically, if Russia, together with Iran, with Iranian gas turbines, and using nuclear power plants, which they have in Kola Peninsula for the supply of the LNG plant, will build all these gravity-based installations. And somehow the real bottleneck is with the shipping. So if they will be able to solve this shipping issue with the help of China, then we have a completely different picture. And most importantly, about the demand. These LNG will be supplied only to the friendly countries, which means that the economies which are now not able to afford gas, it is changing the whole picture. I see also the question in the Q&A box regarding an eventual peace deal between Russia and Ukraine, whether it will open the flow of low-priced Russian pipeline gas. Well, first of all, it's not that low-priced. It wasn't during the last years. But also, only if it is a real peace agreement and the whole reset of relationship between Russia and the West. Otherwise, I cannot imagine gas flowing through Yamal Europe, through Poland, or any approval for restoration of Nord Stream 1, Nord Stream 2. So it's again very, very much dependent on geopolitics. And right now, when it all became a war of attrition, actually, I do not see any signs of Russian gas coming back to Europe, at least in the horizon of this outlook until 2026. More likely it will go down because Ukrainian transit deal is expiring. So I'll stop on that.
Yeah, sounds like you're suggesting that even if there is a huge surge in Russian LNG, it's not going to mainly flow to Europe. So, of course, you know that there has been some discussion around the potential ban on Russian LNG imports into Europe. But it sounds like it's not going to have a huge market impact. And I also want to invite everyone else who wish to comment on this, but curious what your take would be on a potential import ban on Russian LNG in the European Union as well. Dennis, you want to comment on that?
Not so much on the potential import ban, actually, but more on the previous point that Tatjana was addressing the question in the Q&A about is there a chance of Russian pipeline gas coming back to Europe? I fully agree with Tatjana. I think it has two drawbacks which are very, very difficult, if not impossible, to overcome. One is the political one. At the moment, it's political suicide to try to import Russian gas into Europe. And the second one is unreliability. There have been what looks like very clear breaches of contract. And so who's going to sign a contract, long-term or even short-term, and say, okay, we rely on Gazprom as a supplier to now honor its commitments it didn't honor previously. If it's unreliable suppliers, who's going to buy into that? And in this, I fully agree, if there's a full peace in Ukraine, which we hope will come, and there's a change of regime maybe in Russia, okay, but that's all speculation. For the time being, it's really, really unlikely.
Very good. I see also a question about Mozambique and what role it will play in the future LNG supply. I know the report actually has a whole in-depth spotlight piece on Africa's natural gas and LNG outlook, which of course LNG in Africa has received a lot of attention in the wake of the European energy crisis and some renewed excitement. So if you can perhaps comment on how Africa and Mozambique in particular fits into the future gas and LNG supply picture, that would be great.
No, of course, Africa has an immense potential. Unfortunately, due to the security concerns and issues with governance in many countries, this potentially is in a way at risk, especially when you are considering that there are investment opportunities in markets where you have better access to energy services, better governance, and also relatively cheap feed gas supply. Now, in Mozambique in particularly, of course, there are several large projects, planned projects in the country, one of them being Mozambique LNG, which have started construction phase, but then due to the deteriorating security situation in the country, it has been stopped a couple of years ago. Now, our understanding is that some of the key stakeholders of the project are considering to restart this project, potentially targeting a restart in potential start in 2028. So falling beyond the horizon of this particular report. Now, maybe just one thing to consider is that by 2030, we foresee 250 BCM of LNG liquefaction capacity hitting the market based on projects which are either under construction or have taken FID. And this number does not include Mozambique LNG. So, this is just to showcase that the market space is getting in a way crowded. And some of the concerns I mentioned about Africa are, of course, weighing into that picture. That's That's a short response to a very, very complicated topic.
Excellent. I think we would be amiss if we didn't cover your excellent analysis on low carbon gases, which you include regularly in your reports. So just very briefly, I mean, the numbers you put out are very impressive, but at the same time, for example, if you look at the EU's REPowerEU targets, 35 BCM of biomethane by 2030, 20 million tons of green hydrogen by 2030, you know, the numbers you are forecasting through 2026 are only a small fraction of that. So my question is it time to call a reality check on some of those EU targets, or is there still a conceivable accelerated pathway which could bring us closer to reaching those targets? Please keep this very short because we have only about 2 minutes left. Thank you.
Yes, so on low emission gases, I think that it is first important to note that some of the targets are not binding in nature, but then there's also a second point is that the way we see their deployment is that they will move to an accelerated pathway. If the policy design and the subsidy schemes are tailored in a suitable manner. And I think that one message which is quite important is that when it comes to low emission gases, the subsidy schemes and the support mechanisms need to be tailored in a way that they are addressing the entire value chain. At the moment, for instance, when we are looking at low emission hydrogen, we see that the demand targets are actually significantly lower than the production targets of governments. And this creates a huge gap, which I do call the hydrogen gap. So the two, of course, needs to be balanced in a way in order to facilitate offtake agreements, which are still seen by most of the project developers as the most suitable mechanisms for risk sharing. So what we see is that there have been a quite strong policy and support mechanism focus on the supply side, not sufficient on the demand side. And this is probably one reason why the full potential of hydrogen haven't been unleashed so far. But again, our forecast goes until 2026. Then there is 4 years which could open the way for an accelerated growth. But some of these design issues at the policy level needs to be addressed.
Thank you very much, Gergely. Unfortunately, we are coming to the end of this webinar. Before we wrap up, let me thank our speakers once again for joining us today. And big thanks also to all of our audience for tuning in. As I mentioned earlier, the full video recording of this event will be available on the Center on Global Energy Policy's website in a few days' time. Our next event will be held on the 23rd of October at 12 p.m. Eastern Time. And the topic of that event is Artificial Intelligence for Energy, AI, and Energy Technology Discovery. For a full list of our upcoming events, please visit the Center on Global Energy Policy website. We hope you enjoy the rest of your day, and we look very much forward to seeing you again. Thank you and goodbye.
Thank you. Bye-bye.
Bye.